okay? Okay, so let's shift gears. I want to look at something altogether related and different. So what I've done is I have put together a model form that you've simply not seen yet. And I just want to talk it through because it's not insignificant with respect to what you're dealing with. So what I've done is I have a hypothetical scenario, and I think you guys are looking at my spreadsheet, right? And by the way, I threw this spreadsheet together this afternoon as I was just kind of mentally preparing for our discussion tonight. I knew the kind of thing it was going to look like. And so I've got some variables over here, and then I've put some values next to them, and I've done a little bit of math. I'm now starting to use some of the inputs over here on the left to get some monthly outcomes that result in some operating income, okay? And I then, as would not be surprising to you, I'm then taking some of that information and plugging it into a multi-columnar valuation structure. So I can then determine whether or not the operation discussed through these inputs and the model reflecting what the inputs are doing and how we might use them to determine a value, if they make sense. Okay. Now notice, and I'm gonna back away from this in a minute, but notice that I'm creating something and I'm giving it whatever the first year is. So I give it year one, and I use year one. I give it a discount rate. We'll talk about how I determined that in a moment. I give it something we refer to as a run of operation. So for how many periods of time, years perhaps, would I expect this scenario to play out before I required that it gave me some rate of return or some net present value. In this case, I'm adding a production line to a company by the name of Almaden Technologies. And you've not seen anything on Almaden Technologies. It's a company I know very well. It happens to be one of Leland Manufacturing's largest customers. Leland Manufacturing is the contract manufacturer for Almaden Technologies products, and Almaden Technologies products are a line of, consumer and light industrial drones, okay? And they're considering bringing back in-house the production of their consumer drone, rather than having it made by Leland Manufacturing. So to do that, they're going to put together a production line, okay? And they know it's going to cost them about $1,125,000 to do that. And this is a small company. And so they have to think about, well, if they're going to spend that kind of money, we're going to have to think about how many drones can they output in an hour from this new production line? How many hours can they do that in a day? How many days can they do it in a month? Resulting in how many total monthly units? And then they have to consider, when they start this production line up, will it be at peak efficiency immediately, or will they have to ramp up to some efficiency? So I've given a productivity factor. And then we're going to have to think about, at what rate does it come up to productive capacity? So I'm saying 10% a month. So all I'm doing here is thinking through a scenario to determine revenues and expenses. That's all I'm doing. And whether this is Taft Family Business or Family Search as a nonprofit or anything in between, you've got to be able to consider the elements that are revenue and expense based so that you can consider a cash flow. Because we know once we've got a cash flow or a string of cash flows, we know very well what to do with that, right? We put it into a discounted cash flow model, and then we can run net present value. We can run internal rate of return. We are happy as a bunch of clams when we have cash flows. All I'm doing is creating a series of cash flows. Any question about that yet?
Yes, you said that you were going to tell us how you were going to find the discount rate in cases like small family business, um, or like the family search, like no-profit businesses or what. Yeah.
That's a really good point. It's a perfect time to deal with that, Andrew. So I have taught you to build the cost of capital using the weighted average cost of capital method and using the CAP-M method defined RE, right? And you are relatively good at that. Some of you struggle a little bit more than others at this point, but for the most part, what was completely foreign to you 6 weeks ago, you guys are pretty much on top of that and a whole host of other things. But let's face it, in small businesses, which is what most businesses are, in small businesses, how can we create WAC? How can we motivate CAP-M when we don't know beta because the common stock isn't traded? We just can't. In fact, a lot of small businesses, they don't really think about stock because, you know, I've got Rick's Dry Cleaners. I had $100,000 in my savings account when I decided to put Rick's Dry Cleaners together, and then I went out and borrowed a couple $100,000 from the bank. You know, the only notion I have of cost of capital is an interest rate at which I borrowed money from the bank. So because of that, there's a method referred to as the build-up method. And you're largely going to want to revert to the build-up method when you think about putting together a cost of capital for a small business. And the build-up method starts with what it would cost that business to borrow a significant sum of money. So if it's a business that does $1 million of revenue a year, what would it cost that business to borrow $200,000? If it's a business that does $10 million in revenue a year, what would it cost them to borrow $2 million? Not the owners of the business, not what it would cost them to borrow, because their borrowing capacity may be completely different than the businesses, but what would it cost the business? So as I was talking with one of you, I think we agreed that, you know, for this particular business to borrow $100,000, they probably would have to pay upwards of 10%. It's a small business. And that didn't surprise me at all. In fact, I think that's probably a very reasonable rate for a small but successful business. But that's where the build-up method starts. And then we start to layer on various risk premia. So various premiums for risk. And these are going to fall into a number of categories. The first one is typically a size premium. And in this case, premium is additional rate. And so it's not necessarily a positive thing if you're paying it, right? So size premium. The next one might, and I'll come back to each of these three in a moment. The next one might be ownership premium. And then the next one might be location or country premium. And there may be yet others to consider, but these are the ones that we'll talk about for a moment. So let's make an assumption that we've got Trexler Enterprises. And Trexler Enterprises is owned by Andrew and a close personal friend. And they are the operatives of the business. Without them, the business has a problem. There are a dozen other employees, and a few of those are good, solid employees, but really the rainmakers are Andrew and his very close friend. And Andrew and Trexler Enterprises can borrow capital at about 10% in the open market today. Trexler Enterprises is doing about $2 million in annual revenues. And again, it's got 14 or so employees. And it does business exclusively in Italy. Okay, that's where it manufactures and that's where it sells. So we would start our build-up method with that 10% cost of borrowing. Then we would think about a size premium. And the size is typically going to be adjudicated based upon the size of revenues. And so a $2 million company, while it might be big to Andrew and his friend, a $2 million company is pretty small still. And you would apply probably a 2 to 3% size premium to this company because it's fairly small. And if we're starting from a 10% base cost of borrowing, you might think about simply that as being an addition to that 10%. If this were a $100 million company, our size premium might be 0 because that's a nice size company. If the size of the company were $10 billion, the size premium might be -2. So the size premium can be a positive, negative, or a null factor. Does that make sense? Why would the smaller the company be cause us to increase or pile on additional rate points? What's the issue there? Kylie, any idea?
Is it because it's a larger risk for the bank to loan to that business?
It's exactly what it is. That is exactly what it is. Whether it's from the bank or somewhere else in the market, it's a bigger risk. It's a risk premium based on its size because it's a smaller business. Okay? So the next premium that we can think about is ownership premium. So here we have Andrew and his buddy. They own this company. We've already agreed that without them, the company's got a problem, right? So if something happens to Andrew, yeah, maybe his buddy and some of the people that have been working there for a while can cause it to limp along, but they probably are limping along if you lose somebody with the dynamics of Andrew Trexler. So a small company with only a couple of key employees, owners or otherwise, you would apply a ownership risk premium of, again, 2 to maybe 4%. In fact, in this case, where they're friends, small company, not a lot of other people to rely on other than a handful of people who've been around for a while, I might even throw in a 5% there. Now, you should be asking the question at this point, how do you determine 2%, 3%, 5%, 0%? Well, unfortunately, that's an issue of becoming familiar with the marketplace and familiar with the metrics. And if we're talking about a market of auto manufacturers, it's a different premium than if we're talking about an auto or market of cheese manufacturers, right? Or of hairdressers. Just depends on the market that we're dealing with, the industry we're dealing with.
Rick?
Yeah.
But like this, so you were talking about the individuals and how they can make a difference. Like, would somebody also value, like, let's say the premium based on if Andrew is there or Andrew is not there, and can you do that based on personality, or do people usually add premiums based mainly on? I know that that's what you've been trying to say, but I don't understand how you do. How do you measure a person that is still like, if you're Steve Jobs, that's easy. You know, you're famous, you're a VIP, everyone knows you. But let's say that you're the future Steve Jobs, but nobody knows that. Like, how do you is it possible to value that or no?
It's hard. It's hard. In fact, anytime we start to move away from these nicely prescribed models like WAC, it becomes highly interpretive. So how would I do it? So I do it strictly based upon the number of employees in the company and whether or not the existing owners are key workers in that business. Well, in Trexler Enterprise, you and your buddy still are. But now let's assume it's not Trexler Enterprise, it's Rogers Incorporated. And yeah, Taylor happens to own it, but he hasn't stepped foot in there for 3 years. Shen Zhang and Michael Allen have been running the thing for him. Well, now it's not strictly an ownership premium, is it? Now it's a management premium. So this falls into a category. You've got to be able to be interpretive. Or it's a very big business. Maybe it only has one owner. It's Sheng Zhang. It's got one owner. Happens to be a $5 billion company. Well, you might say then that if this owner is an investor rather than truly operative in the business, which, let's face it, is what we have when we have one person sitting atop a very large entity, then there's not much premium that you apply to that. Because you can take that one person out and exchange them for somebody else of high skills from virtually any industry and get the same kind of output, right? This kind of becomes very interpretive. But you've got size premia, you've got ownership premia, and the next most common category working on the build-up method is country or location premia. There's a guy by the name of Aswat Damotar, and you'll remember that name from the first couple of weeks of class and seeing some videos and such. And he has a whole publication on country risk premium. He also, by the way, has size and ownership premium publications. But the one that he updates every month is the nation state risk premium, the national country risk premium. Excuse me. And if you look at this in Italy, the risk premium is about 4%. In the U.S., it's about half of 1%. In Australia, it's about negative 1%. And so the risk premium is, the country risk premium is all about how risky is the company because of where it is doing its manufacturing and selling. So it's not just one or the other of those, it's both. So I said Andrew in this case had both manufacturing and selling in Italy. And so that warrants about a 4% risk premium, because the economy in Italy with about 25% unemployment last I knew pre-COVID, and this is pre-COVID, that's tough, right? And the economy had some struggles. Spain would be in a similar situation. Greece would be rather worse. Sweden, Norway, Finland would be better. They would have maybe a 1% to a 0.5%. So those are the three categories that you layer on top of the cost of borrowing in the build-up method, and then you simply sum them up. So that's the build-up method. And that's how you would normally deal with this for a small business. Now, that said, since you're not going to likely go ahead and take the opportunity to access those risk premia or the cost of capital tools that will help you find them, I would say that in your scenarios, if you're looking at a company doing a project, let's say Michael Allen's looking at a company and they're looking at adding a production line like we are over here with Omni Technologies like we've started. We're going to come back to that. You would say, okay, where are you going to get the money to do this? If it's going to come from cash, then I simply would input a cost of capital being the opportunity cost of cash. If it's going to be from borrowing, I would have it be the cost of the borrowing. If it's going to be from raising new equity in the marketplace, I would try to have it be the cost of equity. That's going to be the hardest to determine. What would you suppose, and Mario, I'm going to turn to you for a minute since I've left you alone so far in our conversation. What would you suppose, how would you suppose you'd go about identifying a company's cost of, opportunity cost of cash?
The opportunity cost of cash. I have a question actually for you.
Okay.
When you were asking about the risk-free rate, I've seen, I'm doing my project, my capstone right now, and I've seen two valuations that are using the Treasury bond, U.S. Treasury bonds as that risk-free rate.
Right. And that, in fact, that's what we've used almost every problem set. We've used 2 or a 10-year Treasury bond.
Okay, that makes sense.
Yep. Yeah.
Okay.
Yeah, and sometimes you'll see a 2-year certificate of deposit on a federally insured bank, but those typically track very closely with the Treasury rate as well.
Okay.
So that said, how would you think about, or how would you discuss the opportunity cost of cash on a company's balance sheet? Any ideas? Anybody can step in and help.
Probably,
So
they could probably lend that money out.
Well, they might be able to lend it. Okay. So, and think about lending as being an investment, right? So
Right.
if they were willing, and willing is a lot of the issue here, if they were willing to lend that money out, then the opportunity cost is the rate at which they could lend it.
Yes.
Okay, good. Well, how else might we think about the opportunity cost of cash?
the company's own required internal rate of return.
Okay, so if a company has a 15% required return before they're willing to invest anything, then their opportunity cost of cash, that which they would put into the investment, would be 15%. Very good, David. What else?
Just a bank rate or something where you...
The rate of return they're getting on the cash, right? They're getting what, 0.6%, 0.75%, some terribly low rate. And most people are going to start there, Kate. That's the most commonsensical thing to start with. But I would tell you, don't stop there unless the company is committed to simply keeping the cash on the balance sheet. If they use the cash for investing in investments that are going to seek a particular IRR, or investing by loaning it to others at whatever interest rate, or however, you've got to bring those into the equation. So I said that the cost of equity might be hard to come up with for one of these companies, but the opportunity cost of cash is also really hard to come up with unless you know their preferences for the amount of cash to keep on the balance sheet and that which they would do with the cash that they have on the balance sheet. It becomes extraordinarily interpretive. Okay? I would say the safest way for you guys to look at these things, and this is the way most practitioners would do it, would be to look at what would it cost them to borrow. If it's a $5 million project, what would it cost them to borrow the $5 million? And that would be used then as the discount rate. It's the easiest. And as I've shown you before, most practitioners default to the easiest, whether it's the best or not. Okay? Good question. So as I've gone along here, you'll notice that I talked about productivity increase and such, and I'll talk in a moment about how I used and modeled these. But then I had to think about, okay, that's productivity. Now, how much am I going to sell the units produced for? And in this case, Amana Technologies is going to sell this line through retailers or through distributors that go to retail. So they sell it at a wholesale, and they get about 100% markup. So they sell it at about $195, and it retails out for just less than $400. But that's going to be different for Amana Technologies as it is other firms. And then I'm looking at the variable costs per unit. I know they put about $87.50 variable cost in materials, $52 in production labor, about $12 in shipping. So the average variable costs are about $151.50. Now, you don't have to put it together exactly like this, but you have to think about these kinds of things because you're coming up with some revenue, and that's going to be a function of productivity and how much you sell the item for, and expenses. And I like to break expenses down into variable and fixed costs. I'm going to hope that in your MBA 603 class that you talked about variable and fixed costs and talked about break-even analysis. Did you? Good. Okay, so these terms shouldn't be all that foreign to you. So I went ahead then and I said, okay, we now are going to bring this production line up and identified, given the numbers I'm putting in here, this is going to have a capacity of about 8,800 units per month, and that is the output per hour times the hours per day times the days of the month. That's all it is, okay? If I was going to run this in 2 shifts instead of 1, I would put 16 hours. And again, there's nothing magical about how I've done this. This is simply an exercise in critical thinking, commonsensical thought with respect to the creation of revenues and the creation of expenses to get to some operating margin or income. Let me put this back to 8. So I go down here and think, okay, fine, I've got the productive capacity figured out. I put in a new production line, a new warehouse. It's going to cost me $1,125,000 I've got up here. To do that, that's what's going to cost me for the equipment. Give me about 8,800 units a month. That's good. But I'm going to have some new salespeople to help sell that product. In fact, I think I'm going to need two of them. They're going to have salary and bonuses of about $90,000 a year, benefits of about 20% of that, overhead, which is employer side of FICA, FUTA, SUTA, UTA, workman's comp, those kinds of costs of another 10% or so. And then I'm going to have some production management because all those production line workers are going to need somebody to manage them. So I got salary and such. probably going to have some additional customer service costs because I'm selling that many more units. I'm going to have some additional customer service expense each month. I'm going to have some expanded monthly marketing expense. And I'm going to have some depreciation. Remember, depreciation is a operating expense. And if we're spending $1,125,000 on a production line, then I have to think, what is my depreciation method? So in this case, I'm simply inputting my depreciation is coming from a 7-year straight line depreciation model. You could choose 10 years. You could choose adjusted cost recovery system, accelerated cost recovery system, modified cost recovery system, whatever system you thought based upon the company you're dealing with and based upon the kind of equipment that they'd be buying. But you've got to include depreciation. Otherwise, you never transfer the cost of the asset from the balance sheet to the income statement. And that's an absolute requirement. And it's been in all of our model forms to come up with free cash flow, right?
Rick?
Yes.
So each of these, not voices, but each of these fields, you want us to explain these fields in the story of our essay, correct? Like, for example, do you want us to say why we choose 7 years? Like, or like 9 years? Let's say that a camera, it's 8 years. Would you want us to also explain it with a reference, or it's just enough to say the average depreciation and we pretty much choose from it? Like,
so that's a very good question, Andrew. And I would tell you that if it's a number, if it's depreciation that we're talking about, and if you told me that you selected an MA,
any field.
But I'm giving you an example, okay? So if it was depreciation and you said, I've elected to use modified accelerated cost recovery, and that's going to result in depreciation expense in year one of $110,000, that would be a sufficient description for me, okay? If you're talking about you've got a salary for a sales rep, and if you give me a number that fits within the expected parameters of a good sales rep salary, then you don't need to go much further. But if this number, instead of being 90,000, if it was 250,000, you better explain to me how you think they're getting there. So you can think about parameters. Okay. Now you're going to say, well, Rick, I don't know what your parameters are versus the ones I'm thinking, and I'm okay with that. If it's something that just fits into some normal parameters in your mind, I'm able to assimilate it in mine. Okay. Okay. So again, all I'm doing here is I'm putting together a series of variables that in this case are the variables that we would need to have to determine revenue and expenses for this enhancement of this company, the addition of a new production line. And if you're going to give me a new production line, you better give me also a way for those new units to be sold. Because otherwise, I'm going to be left to believe that you're going to have a warehouse full of new units and they no place to sell them, right? Now, if you say that you get customer orders already that are more than you can support, then fine. But give me some way to believe this and think this. Now, I'm talking in terms of your project, but I'm also talking in terms of any way you're going to use these metrics on a localized basis in the future. We've been dealing with this from a very global perspective. And when I say global, I mean an entire system, the entire company. And we've talked more recently in the last 3 weeks, a little bit at a time, about localizing, making it smaller, project-based inside of the company. So depreciation. Do not forget depreciation if you're buying some capital equipment, okay? In this case, we've got this new space. We're going to have some rent for the space. I'm saying $12,500 for this particular one. Going to have some utilities to not only light this and heat it, but internet the thing. And also, if we're using a big production line, we're using a lot of electricity. And so we're going to have some meaningful utility cost. And then I simply go ahead and put all of this into a monthly, and I didn't note that this was monthly, so I'll do that. A monthly fixed cost. Notice that in the fixed costs, these costs are going to be here whether these salespeople sell 1 new drone or 10 million, whether the production environment creates 1 new drone or 1 million, these costs are here. Whereas these costs, the fixed costs are here. Whereas the variable costs are specifically associated with the units of production. There are some business methods where there are no variable costs. I think, or there are virtually no variable costs. Software is a really good example of this. So if you and your software geeks come up with a great software solution, whether you sell 1 subscription to it or 1 million a month, it costs you those software geeks, right? So make sure that you're able to articulate when you do this both for your project and for when you just do it in real life. Make sure you can articulate fixed and variable costs. When you're talking to investors and when you're talking to bankers, they want to hear this kind of discussion. When you're talking to critical decision makers in the CFO's offices, this is their language. And whether or not you think you're going to have to deal with finance, obviously we're in a finance class, but some of you are absolutely committed to never have to interface with finance again. And I am here to tell you that while geeks may rule the world, they turn to their financiers for every decision they make. Okay? So all I've done is give myself a structure so that I can come up with some monthly revenues for the first year. This is how I happen to choose to adjudicate this, to ramp it up for the first year. And I then go ahead and do my revenues, my variable costs, my fixed costs, and then it brings me down to some operating income, which included some depreciation. Notice that I don't have net working capital here, and I don't have net capital spending. I have this great big honkin' cost investment for the production line. I have a discount rate. I have a number of years I want this thing to run to be able to justify itself. I'm starting in 2021. Any additional questions about where I am and why yet? Okay.
Wait, I just have one quick question, Rick. So
Okay.
On that piece you just mentioned about production line. So I guess what you're getting at there is like if you're looking at like a small business that doesn't generate, I don't know, I guess you'd say, I want to say traditional financial statements, but you can generate like a balance sheet in QuickBooks. But let's just say, I think that's the point you're making, right? It's like you may not have all your assets laid out so that you have all those calculations ran. You just have this one production line cost. And sometimes the scale of a business is so much smaller than having all these different asset categories. You just have one main asset that you're relying on to do a lot of your production, basically.
Yeah, exactly. Now, in this case, Matt, I might have said, well, I need a production line and I need some new delivery trucks. That would be another line item for assets, right? Which would together, the cost of those might be my capital cost for this new operation. Yeah, exactly.
But since you just have the one in this case, there's no reason to, like you said, there's not even a reason, there's not even a way, I guess, to calculate out those other invested capital, net capital spending metrics. It's just not necessary. So it's overly complicated.
Yeah, if this was going to be a 25-page pro forma on something that you're going to have to run by the board of directors of the company and get the CFO to sign off on, and get all the planning and IT people and get the lawyers involved in, then you would give us a level of detail here meaningfully greater than that which we're discussing today, or you're discussing for your projects that I do not want to see go over 4,000 words. Okay? Yeah, because I got to read them. And if they're very long, make sure they're really, really good, because I'm grading Kate's next. And she wants me to be in a good mood when I grade that brand of torture that I put her through. Right, Kate? Yes, ma'am. Okay. There's nothing magical about the variables we've discussed so far, other than they bring me to an operating income based upon the scenario I'm looking at. That's all they do. And you could have set it up as an income statement. You could have set it up as just a list of expenses. You could set it up a lot of different ways, but articulate it so it is clear to whomever is looking at this that you have mentally gone through the process and you're not just throwing spaghetti at the wall. You're trying to give some sense of reasonable, thoughtful consideration to this. If you give too surface an assessment, then no one's going to believe it or respect it. If you give one that is mired in detail and you give it to decision makers, then you may as well have just left it on the shelf because that's where they're going to put it. Okay? So executive summaries, when you do these kinds of things well, are very important. In fact, you may choose to do an executive summary, but it's going to be a very brief executive summary. It's going to be maybe a paragraph or two in your project. So again, all of this has been to bring me to a cash flow. And my cash flow, when I've come to the bottom line for the total of that first year, is $109,486. And once we have a cash flow, we know exactly what to do with that cash flow. We put it into our multi-columnar model. Okay? So I stopped at this point when I developed this purposely. I now want you to help me build the rest of this out. And I want to come up with an IRR. So with this being my cash flow in year one, what am I going to do next?
Find a cash flow for year two.
I think that's a very good idea, Diana.
You got to come up with a growth rate, right? Like a projected growth rate?
Very good. So in this case, I'm going to tell you that we've decided for this particular project that we're only going to put in the one production line, but we may be willing to allow it to go from a single shift to 2 shifts as the need arises. Okay? So in the first year, we've taken this from, we started it at a 60%, excuse me, I think that was 50%. Let me go back and look for a second. No, it's 60% operating capacity. Then we ramped it up all the way to 100%, and we kept it at that for the remainder of the first year. But we believe that in the second year that we're going to be able to have the exact same experience. So we're going to put in another shift on this same production line. And that in this case, we're also going to have to hire yet more salespeople and yet more production workers, etc. So I'm just going to go ahead and, for the sake of simplicity, given that brief explanation I gave you, I'm going to go ahead and then say, since I know that I've done that, I've got a parameter I'm going to have to build someplace, and I'm going to call it an annual increase post 2021. And I'm going to call it 200, or rather we're going to call it 100%. I'm never going to put a hard number into anything I'm putting in my models. Notice as I open any of these up, I've got values, or rather variables. I never have a hard-coded number. Just as you know, you'll never have a hard-coded number in here. That way, I can change all of what's happening here simply by changing 1 or 2 or 3 things over here. That's the virtue and value of a model. So in this case, I believe that in my second year, I'm going to take my first year's results times 1 plus this expansion. It'll give me my second year's cash flow. Now, that's probably an imperfect way of having done it. I maybe want to get a little bit more circumspect and prescribed with the benefits and how many salespeople, and do I really have twice as much rent? Do I really have twice as much utility? I probably don't have twice as much rent. So I would have to think about that. But for the sake of what we're doing together, I'm fine with that today. And we also decided as a company with Almaden Technologies that once we've gotten this one production environment up to 2 shifts a day, that's going to be the end of our push through this production environment. And we made a decision as a company that we will play this out for 5 years and see what kind of a net present value and an internal rate of return it gives us. We believe that after a 5-year time period, we would have to completely retool the production line because the particular drone we're going to manufacture on this production line will have been outdated within a 5-year time frame. Now, these are going to be things that are part of your story, right? Well, I still need a growth rate beyond year 2, don't I, Matt? So I'm going to put a forecast growth rate. And I'm going to say that in this case, if I'm not going to be ramping up additional sales, I'm going to have to think about just a increase in revenue because of price increases, right? That's all I can look at. Unless I'm going to be selling more units, the only thing that's going to grow my revenue is price increase. And so maybe I believe I can go ahead and play along with inflation at about 2%.
Your price increase, right? Not your own cost, like the price of your product, right?
Well, in this case, I'm going to pretend that I'm in a constant returns environment, Matt. And so the one increase would go across the sections. Yeah. So it'd be, I believe that all of my costs are going to go up because let's face it, is labor cost going up with inflation?
Yes.
Is rent going up with inflation? Is the price that we sell it for going up with inflation? Sure. And since I've chose simply inflation, I'm gonna adjust everything by that, which then allows me to simply go off of another metric. Now, remember, I was ramping up in year 1. I continued to ramp up a second production line in year 2. But if I want to know what the a second shift on my production line in year 2. If I want to know what this production line with 2 shifts does when it's at optimal capacity, I then have to take one of the months of optimal capacity, and I then need to think about taking that month times 2 lines. Where do I have my second line? No, I didn't put it in, so I'm gonna put it right here. Excuse me. And do I have months per year? No, I need to have months per year. I'm gonna put it right here. It's getting a little messy, but I just have to have it somewhere. So I'm gonna take my optimal months, and optimal simply means on one line I'm at 100% capacity of production. I'm gonna multiply it by 2 lines, and I'm gonna multiply it by 12 months of the year. Okay. In this case, it's how it's working out. It's just my story and moving my story from words to numbers. That's all that I'm doing. This is not specifically constructed a way like the APV model is or like your forecast ratios is. This is critical thinking with respect to numbers in an environment. And then I have that, but remember, I now need to expand that by 1 plus this growth factor.
Hey, remind me, how did you get your year 1 free cash flow again, Rick?
So year 1's free cash flow was the sum of these monthly operating.
Okay, gotcha.
And the summation column. That's how I got it. Now you
Right.
might have, instead of doing it monthly, you might have just taken it the first year. You may have just run numbers and said, this is the first year. If you're going to be bold like that, you better give a paragraph or so helping me understand how you go from nothing to full capacity in your first year.
Right, but you got it from operating income aggregated.
Exactly. So you should be asking the question at some point, well, wait a minute. I don't see that you brought in net capital spending and net working capital. But again, we haven't brought them in because we've got our entire capital component composed in what it's going to cost us to put this operation in place.
And that's built into your fixed costs?
Well, it's built into my costs, not the 1,125,000 expressly. It's built in by depreciation.
Oh, right.
What's depreciation? It's
built into your fixed costs.
It's my, yes, and that's in my fixed cost, exactly. It's not my variable. So
It still comes out, it still gets baked in, so to speak, into your final operating income number.
Exactly. Because depreciation is running whether we make one drone or 10,000. The equipment is still depreciating. So I'm going to continue on here. And as it turns out, this number that I just came up with of 1,004,000, that's an awfully big number. And I'm thinking that maybe I'm being a little too optimistic about my overall production capacity. I'm expecting that both of those shifts on that one production line will run at 100% capacity all the time. Is that realistic? It's not. So I might want to think about putting another field somewhere and saying I might only run at an 80% capacity. And in so doing, I've got to factor that in. So now I'm going to bring it into here. I'm still coming up with some big numbers. I don't care what these numbers are at the moment. I care that you think through a series of numbers with critical thought and back them up somehow so that you can come up with cash flows. So I'm now going to say, all right, fine. We've now taken that number and we're expanding it by 1 plus this growth rate that we came up with. And I now have, excuse me. Well, that's a really interesting number. I got to find out why I did that. I didn't do an anchor there. So now I have my cash flows. Okay. So Diana, you were right. Cash flows. What do I do next?
Right.
Back in present value.
Yeah. How do I do that?
Free cash flow divided by 1 plus the discount rate to the exponent of the year.
Exactly what I do. And now I'm going to make sure that I've given the appropriate anchors for these references. And I'm just going to copy it down. And now what do I do?
Sum them up.
Sum them up. So I'm going to start with this one. And here is going to be the one from the year before plus this next one. And I'm going to bring it all the way down. And now I have the sum of my present values of my free cash flows. Okay. And I want net present value and I want IRR so bad I can taste them. How am I going to find them? How will I find net present value? Diana, how am I going to do this?
We can use the formula.
Okay, which one?
That Excel provides us. Equal NPV and then open parentheses.
Okay. Can I suggest we do it a little more simply than that? Diana, is there another way to calculate net present value that is simpler than what you started to do for us?
Yeah, there are 3 ways, but
Okay.
I don't remember them all.
Okay. So I'm going to suggest we take the present value of the benefits and subtract from it the present value of the cost. So the present value of the benefits is right here. That's the sum of those adjudicated over a 5-year period minus the present value of cost. So Carol, with a net present value of $837,000 based on an investment of $1,125,000, what can you tell me about the internal rate of return?
Is it negative then, since you invested more than what it's worth right now?
Well, I think the present value of the benefits is $1,962,000, which is meaningfully greater than the present value of the cost, right?
Yeah.
But I think it's just the opposite. In fact, I think the technical term for what I'm going to expect on this IRR is hunkin'. It's going to be massive, right? Because we invested $1,125,000, and based upon this net present value, we got our discount rate of 10% plus we got an extra $837,000. Guys, all we're talking about now is decision criteria. How would I go about calculating the IRR?
Formula.
Yep, it's the only good way to do it, right? In order to pull that off, I'm going to have to change a structure here a little bit, so stay with me. And I need to put in this,
your investment, right?
pardon me?
You got to include your investment.
I've got to include my investment. So I've got to have it in the same column. Otherwise, I can't pick it all up together, can I, Matt?
No.
I've got to put it in as a negative. And now I can say equals IRR, and I can just pick up all those values and close it out. And I got a 30% internal rate of return. And I think the technical term for that is hunkin'. Okay. Now I could have done NPV here as well. So I'm going to pick up my rate. I'm going to pick up my values. Okay. And I'm going to say minus this. Oop, I've done
So
something wrong.
last time we did IRR on the last column on total PV. Why are we doing it on FCF?
We never do it on total PV.
Oh,
I'll come back and explain why that is in just a moment.
Okay.
There we go. So here I've used the present value of the benefits minus present value of the cost. Here I've used the equals NPV equation to get to the same net present value. So Diana, here's why IRR would never be in this column, because if I did, I would be thinking about a cash flow as a present value, and I don't want to do that and do IRR. IRR is thinking about a present value inside of itself, but these are summative. So this cell is this one plus this, and this cell is all of them combined. And so I'd be summing these, and I would really screw it up if I did it that way. I need to take each of them in turn before they're discounted, because this is the return I get. We don't want to think about the discounting. Okay.
Didn't you say before? Oh, sorry.
I was going to say, if net present value were 0, Michael Allen, what would be my internal rate of return if net present value were 0? Mandy's right. Well, no. If net present value were 0, what would be my IRR, Mandy? No. Anybody know?
Your discount rate?
Yep. Who said that?
I did.
Thanks, David. So David's right. When net present value is 0, the internal rate of return is the discount rate. Maybe
So
okay.
you say before that the modified internal rate of return is actually more accurate? And
Yeah, so let's look at that.
Okay.
So when I do this, I have to pick up the values. I then have to give it the finance rate and the reinvestment rate, which I use the same number. It's only 23% instead of 29. Do you remember why modified internal rate of return is more accurate than internal rate of return?
I remember how it's different, but I don't know why it's more accurate.
How is it different, Matt?
Well, you use the discount rate, and if I recall from the literature that I read, was it's assuming that you're reinvesting it at the discount rate, I guess.
That's exactly right, which is why I picked up the discount rate in my rate components of the MIRR function in Excel.
But if you're doing the IRR, what is the IRR assuming that you're reinvesting it at?
Notice that IRR doesn't ask you to tell it what rate. It imputes a rate based upon its calculations. And unfortunately, it supposes you can reinvest at the amalgamated rate that it's calculating. So it's supposing that we could reinvest at this 29%, which if we say that the discount rate is 10%, then we can't credibly think we can reinvest at 30%. So that's its weakness. It uses as a reinvestment rate the amalgamated or the calculated rate of return. And when we have an IRR meaningfully greater than or meaningfully different than the discount rate, then IRR becomes an inferior measure. That said, it is commonly used. In fact, I've had MIRR conversations with valuation analysts, and they don't know what MIRR is. Because the common thing in finance is IRR, but I'm telling you it's flawed. Okay. How would I create profit index? Do you remember? The present value of the benefits divided by the present value of the cost. When the profit index is equal to 1, what do I know about the IRR?
It equals the discount rate.
I love it when you say things like that. It's exactly what it means. It's exactly what it means. It means the present value of the benefits is equal to the present value of the cost. You're not getting any more or any less. You've got your discount rate. Very good. Very good. So all we've done here, and by the way, I'm going to send this to you, okay? Not because there's anything magical about it. I just think it might be modestly helpful to you. All we've done here is said we've got a story. In this case, Almaden Technologies making some drones. It's going to bring in-house its manufacture of a particular line of drones. And we have to think about what it's going to cost it to do that. We have to think about what revenues are going to come from that and what expenses are going to come from that. And that brings us to a cash flow. And then once we are at a cash flow, we have a method that we can use to identify the values based upon cash flows. Now, there's one element I didn't program into this, and it's glaring, and it must be included. What is it? Any ideas? I figured one of you was going to hit me with it.
You didn't calculate your continuing value or any of those other metrics.
Well, I didn't, because I said as part of my story that we were going to, at the end of 5 years, we'd have to retool this whole thing anyway. So we just wanted to have an adjudication at 5 years. Now, maybe, Matt, I would have said at the end of 5 years, we'll sell this production line for X% of the acquisition cost, or maybe we'd scrap it, but that wasn't part of our story. Okay, so that's why I could credibly leave that out. There's something that is left out of here that's not credible, and it's a glaring error that I will fix before I send this to you later. Think about the free cash flow equation. No plat plus depreciation minus net capital spending minus change in net working capital. We've said that we're not going to worry about net capital spending and changing net working capital because it's an isolated project, and that's embodied in what it's costing us to put the production, this together. But I'm still leaving something out. I'm effectively using EBIT.
So your tax rate?
Thank you.
Oh, yeah.
I didn't bring into account my tax rate. So I need to do that in order for this to be a little bit more well-defined for you. Yep. In which case, the IRR and NPV and such are not going to be as high as they are. So, Xinjiang, if I could convince you, since you're the CFO of the company, and by the way, Xinjiang's favorite response is no. That's what all CFOs like to say. They like to say no. If I could convince you that by spending $1,125,000 that you're going to get in present value dollars $1,962,000 and a 30% rate of return, would you authorize the project?
I think I will.
Yeah, I think you will too, buddy. I think so, because we like to keep our jobs, you and me both. Okay. Does this help you kind of conceptualize how you might do some of the quant on your project? Okay. So guys, this is where we wrap this thing up. We started with a whole series of metrics out of some financial statements that were very prescribed. And with each of you having something less than full confidence that you could turn all of that into something of value. And over the 7 weeks together, you've learned how to go from the antiquity or artifact, which is an income statement and a balance sheet, to something totally prescient, totally market-driven, and that we can use to describe, define, and articulate the value of an entire firm, or we can use to describe and define and articulate the value of a project within a firm and discuss how we would go about making the decision as to whether or not to do this project. My sense is, as you work on your project and as you reflect on this over the coming weeks, you're going to come to the realization that you learned a lot more than you may have supposed you did while you were being frustrated and tortured. Fair enough?
Yes, just one thing, Rick. When do you think you're going to be able to upload the recording?
Oh, good question. My guess is I can do it sometime tomorrow because I don't have other classes and such that I'm working on now. My other classes are pretty much done. Usually it takes me a few days to do it because I have so many other things going on. But right now I don't because of the May term and most of the rest of this being wrapped up. So I should be able to have this uploaded by tomorrow. And it will only be a couple of short segments, right? We've only been together an hour and a half on tonight's call.
Thank you.
You bet. Thank you. Well, guys, I hope that I haven't made your eyes bleed. I've noticed that nobody's ears have had blood running out of the side of them. Tortured though Kate may have been. By the way, Kate, it's going to take you a little while to live that down. Just so you'll know, she disappeared, didn't she? Yeah, she got out of Dodge.
I'm still here.
I can't see you. Where are you? Oh, there you are.
I don't know.
You moved locations in this little deal. As frustrated as you've been through some of this, and I know that you have, I think you've learned a lot, and I think you've got some things you're going to apply, and I hope that you get a sense of why I get geeked out about some of this stuff. I have had what by all descriptions would be a fairly satisfying career that at times has been more lucrative than others, but satisfying nonetheless. That satisfaction has come about by far because of my ability to use the kind of metrics we've been talking about and employing them at creating value for not only other stakeholders, but for myself as well. I'm hoping they're going to create value for you. Whether you are in the finance suite of a corporation or you're on the production floor in the marketing group or somewhere in the operating and the process management part. I hope these can turn into revenue and net present value benefit for you as well. They've been extraordinarily valuable for me. Okay? Any final words, thoughts, comments, put downs, whatever you got for me?
Can I ask a quick question after everyone goes? It's not.
Certainly. You bet.
Here. Okay.
Yeah. All right, guys. Well, I'll stay with Kate. It looks like we have nothing else. And then we do have some assignments and some texting and WhatsApping as you're turning things in. Okay?
Thanks, Rick.
Thank you, guys, very much so. I'll talk to you later. Bye-bye.